Buenos días a todas las personas que nos acompañan. Les damos hoy la más cordial bienvenida. Mi nombre es Silvia Jiménez, gerente de inversiones de mercado de valores, y tengo el placer de compartir durante la próxima hora en este espacio que hemos preparado exclusivamente para ustedes como parte del servicio de portafolios discrecionales, en el cual realizaremos un análisis de la situación de los mercados financieros y económicos a nivel internacional, en el cual se han estado gestionando los portafolios de inversión. Nuestra labor como asesores patrimoniales de confianza es ofrecerles un servicio de contenido con valor y calidad que le permita analizar los escenarios actuales para tomar estas decisiones de mediano y corto plazo. Ha sido un año que ha iniciado con muchos elementos a considerar a la hora de tomar decisiones. Venimos con una Reserva Federal y otras autoridades monetarias desde el 2022 aplicando una política monetaria restrictiva, con un enfoque y un objetivo de contener la inflación que se ha llegado a ubicar a niveles máximos en más de 40 años. Por ende, se viene hablando día con día de la efectividad de esta política para alcanzar los rangos metas de inflación establecidos. Por ejemplo, se habla que en Estados Unidos deberíamos de llegar a volver a ver niveles del 2%. Al mismo tiempo, el mercado viene descontando o conversando cada vez más sobre esa posible recesión que ha sido quizás la recesión más esperada en los últimos años en el mercado norteamericano. Por el otro lado, nos vamos hacia Europa. En Europa que veníamos en el 2022, quizás como una de las zonas más golpeadas a raíz de los conflictos en Ucrania y Rusia, y veíamos como que era la región llamada a vivir un tema recesivo pronto por la parte de las energías, nos ha sorprendido positivamente en los últimos meses. Por otro lado, vemos la vista hacia los mercados emergentes y tenemos a China que flexibiliza finalmente las políticas anti-COVID y claramente esto va a tener un impacto en el crecimiento mundial. Entonces, bueno, ¿qué hay en los mercados emergentes en estos momentos? Por ello, hemos invitado hoy al señor Peter Perkins, que es socio de la firma de análisis MRB Partners en el área de estrategia global. MRB Partners es uno de nuestros aliados que nos acompañan como insumos en el proceso de análisis de los mercados internacionales para la toma de decisión del servicio que hoy les brindamos. Peter Perkins es socio fundador. Tiene una amplia experiencia tanto como estratega como economista. Se enfoca en problemas y estrategias de asignación de activos, impulsores claves de la economía global y mercados de capital, así como en oportunidades y riesgos de inversión. Trabaja en estrecha colaboración con los clientes de su empresa, como lo somos nosotros, Mercado de Valores, en asignación de activos tácticos y estratégicos, ayudándonos a interpretar y traducir todos estos factores macroeconómicos y políticos para lograr la estrategia de inversión que hoy les ofrecemos. El señor Perkins habla ampliamente hoy en día en conferencias, seminarios, reuniones con clientes y participa incluso en comités de inversión para firmas de inversión de alto calibre. A lo largo de su carrera, ha cubierto activos en las regiones y trabajado en Reino Unido, como en Hong Kong, México y Canadá, y hoy en día reside en los Estados Unidos. El señor Perkins tiene una maestría en economía de la Universidad Estatal de Pensilvania y una licenciatura de la Universidad de Maryland. Les recordamos a todos que este webinar tiene la opción de traducción, por lo cual pueden pasarse a traducción simultánea en la barra de herramientas del Zoom, donde ven un globito. Ahí pueden escuchar para ver la versión en español. Si no, se pueden mantener en el canal principal y la escucharán en audio original. Recordamos que este espacio es exclusivo para ustedes, que hoy son parte de nuestro servicio premium de portafolios discrecionales, por lo cual los invitamos a hacer sus preguntas en el chat o en la sección de preguntas y respuestas, ya que al final de la presentación tendremos un espacio para poder conversar con don Peter. Welcome, Peter. It's nice to be today with you to share this webinar. So I will let you make your presentation, and thank you very much for being here.
Okay, thank you very much, Sylvia, and thank you everybody for attending. There's a lot to cover, and so I'll try to proceed relatively slowly. I know this is being translated, but there is a lot to cover, so hopefully we can get through most of the presentation itself. So let me first share my screen. So let me start by saying, if you look back over the past year or so, our firm, MRB Partners, has generally been broadly constructive or positive about the global economic outlook. That doesn't mean we're necessarily positive about the investment climate, because there are certain elements of the investment climate that make it difficult. And as the title of this presentation indicates, we're in the very late stages of the investment cycle. And as a consequence, no matter what your view of the economy is, you need to be more conservative than you might be if we were at the early stages of an investment cycle. So that's a general thesis to highlight. Obviously, most of the emphasis in the past couple of weeks has been on the financial sector, but let me just run through the overarching views that we have, and then I'll go into some greater detail on the topics at hand. So the first thing is ultimately we believe the financial crisis that we've been experiencing over the last 2.5 weeks is going to be contained and is not going to trigger a US or global recession. There will be a US or global recession sometime down the road, but this is not really the trigger for it, because fundamentally, and I'll touch upon this again later, the US and European banking systems are pretty solid. The second thing is that when you look at the landscape today, cash yields are attractive relative to other alternatives. There's been a lot of volatility in the bond market over the past couple of weeks, but the front end of the yield curve, in other words, let's say 3-month treasury bills or up to 12-month treasury bills, we find attractive, both because they're safe, but also because they provide a pretty good yield in the environment that we're operating in. So in general, in a portfolio, a balanced portfolio, we're overweight cash. We're still cautious about bonds. They've been rallying a bit over the past couple of weeks, but we still see risks for yields as to the upside in the near term. And of course, that will undermine capital values for bonds. So we're cautious about that. Partly that's, and I'll elaborate later, partly that's because the market is pricing in pretty aggressive Federal Reserve rate cuts over the balance of the year that we believe will not take place. On the equity side, we're kind of neutral right now, but we have a negative bias because, as I said, not only is it late in the economic cycle and investment cycle, but the profile of global equities with such a large weight in the US and us finding that neither value nor the earnings outlook really is very favorable for the US equity market. So that tempers our enthusiasm overall. We still like European stocks, we still like emerging market stocks, but the upside potential for those markets is limited if there's limited upside for the US, as we see as being the case. So for equities, we're still mildly constructive about them, but our bias is that we're more likely to be downgrading them to underweight rather than being upgraded to overweight from our current circumstance. We don't particularly find commodities attractive, and that includes gold. We would not be buying gold at current prices. So that's an important element of the overarching strategy. And the US dollar has been pretty soggy despite this banking sector crisis that would normally be a risk-off environment, we think the dollar is going to be weaker a year from now than it is today. So that's a general backdrop for our views. Let me turn to the financial stability issue and banks in particular. As you know, banks have been under considerable pressure over the past couple of weeks since the bankruptcy of Silicon Valley Bank. And you can see, bank stock prices have really reversed course. They were on a pretty solid uptrend until Silicon Valley went bankrupt. And we've given back all of those gains in the past couple of weeks. And these are, bank default swaps, credit default swaps, and yields have increased quite dramatically on those, reflecting perceived underlying risks in the banking sector themselves. Part of this has been the SVB thing. Part of it was the Credit Suisse bankruptcy. That's, or not bankruptcy, but its sale to UBS, and there was a lot of anxiety about that. But the rise in credit default swaps is a concern because it underscores that investors are increasingly concerned about the health of banks. We think the market is overreacting, but that's a crucial thing for us to keep tabs on in the very near term. US banks, following the bankruptcy of SVB, as well as Signature Bank in the United States, US banks have tapped the Federal Reserve for liquidity to support their operating conditions right now. So we've seen this dramatic increase in loans from the Federal Reserve to individual banks, either through what's called the discount window or a new financing program that the Federal Reserve has introduced. Banks have borrowed more money in the past couple of weeks from the Federal Reserve than they did during the 2008 crisis. Now, of course, it's important to keep in mind the banking sector is considerably larger than it was then, but banks have really had to rely on the Federal Reserve to provide liquidity in the short term when customers were worried about the health of deposit and the stability of deposit. So that's been a very important thing. It is very important to keep in mind, though, that when you have a banking crisis or a lack of confidence in the banking sector, it's central banks that ultimately have to provide the support, and the Federal Reserve has really stepped up to do that. And that's a crucial element of our view. The Federal Reserve or the ECB, or central banks more generally, are not going to sit idly by while stresses in the banking sector emerge intensify because, of course, as Christine Lagarde, the president of the ECB, said the other day, it's impossible for monetary policy and interest rate policies to work if the banks are not functioning. So the banks are really part of the monetary policy transmission mechanism. They have to be stable and they have to be liquid in order to function properly. And so it's a central element of central bank policy to provide support to them. And that's been the case. That's reassuring. And it's a reminder that central banks will step in and have stepped in to try to provide support to restore confidence in the banking sector. All right. Now, a corollary that we have seen over the past couple of weeks has been a sharp decline in US Treasury yields at the short end. So 2-year Treasury yield has fallen by more than 100 basis points because the market has gone from expecting the Federal Reserve to tighten monetary policy to now expecting them to ease monetary policy. Now, when you just look at the magnitude of the move, I think it's safe to say that it's possible there's an overreaction, and that is our belief. But this has been a dramatic turn of events for the bond market because, just before the SVB crisis, we were above 5% on a 2-year yield and still trending higher. So the banking crisis has caused a dramatic change in the bond market for now. And the other thing that's very important about what's happened is volatility in the bond market has increased quite dramatically. And if you just think about an investment backdrop, when the bond market is volatile, it means that the asset that's supposed to be stabilizing in a balanced portfolio is itself unstable. And anytime most assets are priced off the US Treasury curve in some way. When you have volatility in the US Treasury market, it's very difficult to price other assets as well. So this is a real concern right now. It's likely to come down as the Federal Reserve and other federal authorities contain the crisis in the banking sector. But until then, that volatility is a cautionary note for investment for portfolios and risk appetite. A couple of observations just about the US financial system. There's a lot of banks in the United States, but 13 of them, names that you will know, account for almost 60% of the total assets and deposits in the system. So there's a lot of banks, but most of them are not central to the banking system. Now, SVB was not in the 13 largest, but it was a pretty big bank relative, I think it was the 15th largest bank. So it was much larger than most of the banks in these 4,700 that exist in the United States. But that's important to keep in mind. The big banks dominate the banking sector. At the end of the fourth quarter, and that's the last data that is formally published by the regulator, there were only 39, so less than 1/10% of the banks in the United States were considered problem institutions. And those banks only accounted for $47 billion of assets. And, it's a $23 trillion asset base, so very small. But of course, that underscores, since SVB was about $215 billion of assets, that the Federal Reserve had not identified SVB as a problem institution at the end of the fourth quarter. So, this data is reassuring in terms of the sizes, but at the same time, it's a reminder that regulatory authorities don't necessarily always see the problems looming far in advance. A couple of other observations. One important, indicator of bank health or vulnerability would be the loan to deposit ratio. So how many loans outstanding are there relative to deposits? Because if there's a lot of loans relative to deposits, and either there's deposit flight or loan problems, then banks start having to really rein in credit availability. But when you have a low ratio like this, it means that banks actually have a lot of deposits relative to the number of loans outstanding. They can afford to see some loan losses. They could even afford to see some deposit flight without it jeopardizing their financial health. And to put this 64% number into context, ahead of the crisis, the financial crisis in 2008 and 9, the US loan to deposit ratio was 98%. So there was very little flexibility back then. And as soon as problems started to emerge, banks were required to shrink their loan portfolios. Today, they would be under much less pressure to do so. And the other thing is that even if deposits were to fly, as they have been over the past couple of weeks, from banks into, let's say, money market funds, there's still no pressure really for banks themselves. They have strong capital bases. They're in the best health they've been in some 20 years. They're highly profitable. That's helpful. They've become more profitable as interest rates have risen. Now, the thing that has really been a source of anxiety in the financial community of the past couple of weeks is what are called unrealized losses on securities. So banks own a lot of government bonds, treasury securities or mortgage-backed securities as well. And the price of those has fallen as interest rates have risen, and that creates the potential for losses. But this is really partly an accounting issue and partly a liquidity issue, but they're what are called unrealized losses. They don't have to be recognized unless banks sell the bonds, which they don't have to sell. And given that they have a lot of liquidity, the pressure to sell bonds is very low. But again, confidence is everything in the financial system. And if confidence starts to fade, inevitably, policymakers, whether that's the Fed or the Deposit Insurance Corporation, has to step in to try to restore confidence. I think the measures that the Fed and the FDIC in the United States have taken will go a long way to restoring confidence, but there is still some lingering uncertainty out there because a number of institutions are problematic institutions and are vulnerable. And right now, if another bank went bust, anxiety in the markets would intensify. So we're confident that the authorities are going to contain the problems, but how quickly and what's required to do so remains to be seen. And until they do, of course, markets are going to be volatile, and risk appetite is going to be very limited. So a couple of other observations just in providing a little bit of backdrop before I get into the monetary backdrop. The U.S., as it says here, the U.S. and Euro area banking sectors are healthy, and they're not really at major risk, right? Banks can always be at risk if confidence fades, but the fundamentals of their balance sheet and their profitability are the crucial dividing lines between a crisis in confidence that can be resolved and a crisis that ultimately overwhelms the system. This is nothing like 2008 or 2009. And I'll show a chart to support that as well. But we still need some additional policy commitments. From a global economic standpoint, there's a couple of other things that are important to keep in mind. One, China's economy is reopening. China's a very large economy, as you know. That provides support to the global economy, and it's very timely that China is recovering from its COVID restrictions last year. That's very helpful. The Euro area economy has been gaining momentum because the energy crisis that was caused by the Ukraine war proved to be much less intense than people had anticipated, and prices and pressures have eased quite dramatically compared to the summer. So Europe looks like it's in a position to see an improving economy, and indeed economic sentiment was improving in Europe ahead of the banking crisis, and we think this is not likely to really dent confidence too much, but we'll have to see on that. An improving European economy and an improving Chinese economy are very helpful, not just for emerging markets, but for the global economy as a whole. And we still contend that the US is going to avoid a recession because the consumer's in pretty good shape, and the corporate sector is in quite solid shape as well. And while there are lots of issues out there, the consumer is not as sensitive to rising interest rates as I think many people believe is the case. And both the consumer sector and the corporate sector have pretty strong debt servicing capacity to deal with any problems that arise over the course of the next year. So lots of people talk about recession risks in the United States, but if there were to be a recession, and we think it's unlikely, but if there were to be a recession, it would be very shallow, much, important for capital markets, but probably not very enduring and not very deep, right? A challenge, though, is that if you have sturdy economic growth, it means that underlying inflation is likely to persist, and that's going to be a problem ultimately. And I think that is the driving force behind our conclusion that the recent interest rate cuts that the market is now expecting from the Federal Reserve and the ECB, for that matter, are unlikely to be delivered. And that, that's an adjustment process that still has to take place. So, the backdrop for the global economy is reasonably healthy. And if the banking sector crisis if confidence is restored, as we expect relatively soon, you should expect to see bond yields drifting back up at least a bit, interest rate expectations from central banks drifting back up a bit. And of course, then the focus will return to inflation for central banks. So let me turn to that for a second. The inflation issue as a prelude to talking about the monetary policy. There have been some very positive developments over the course of 2023, second half of 2022 and 2023. Food and energy prices have come off significantly. In fact, they're contracting on a year-over-year basis. That's going to drag down headline inflation. Supply chain pressures have eased quite considerably. Goods prices in general are now, the inflation rate is either very low, or in some cases, goods prices overall are contracting. That's positive. The offset, though, is that service price inflation in the United States and in Europe remains quite strong, right? And that's the sticky element that is likely to persist. So inflation may be peaking, particularly at the headline level. It's already rolled over a lot, but the path to getting back to something like 2%, which is central bank's targets, I think is still going to be pretty difficult. And we don't expect it to be achieved over the course of the next 12 months. So the battle against inflation is going to persist. Just a couple of simple observations on that are important to understand, I think, when you're thinking about monetary policy. When you look at this is a chart that shows wage gains in the United States, this is one measure of them, running at a little bit more than 6%. And a measure of how tight the job market is, which is the number of job openings in the United States economy relative to the number of unemployed people. And that number is very high. Companies are very anxious to still keep adding to payrolls. And it's very difficult to believe that wage inflation is going to come down a lot unless the job market eases a lot. Now, there's many reasons why the job market may ease, but if you're the central bank, you have to believe that the only way to get the job market to ease is to continue to squeeze domestic demand. And that tends to imply further upward pressure on interest rates, unless something goes wrong otherwise. The banking sector is one possibility, but if you resolve the banking sector problems, then you're left with, we're going to have to bring down inflation by cooling the economy ultimately, and that corresponds with raising interest rates. And the same is true in the service sector, where there's a lot of wage inflationary pressure, and inflation is simply too high for the Federal Reserve to be comfortable about things. So, the Fed's focused on the banking sector crisis right now, but ultimately in the service sector, where inflation is quite sticky, the Fed has a problem, and that's an issue. Conflicting objectives for the Federal Reserve makes their job much more difficult. And the same really holds in Europe, where inflation has peaked, but underlying inflation remains very strong. And what's really happening is that we've seen, a dramatic decline in energy price inflation, which is appreciated, no doubt, by everybody, but it doesn't really change the underlying dynamics of the inflation backdrop for Europe overall, because core inflation remains very strong. So when we're thinking about monetary policy in the US and Europe, for example, right now, financial stability is the paramount issue. That's the number one objective, because as I said, you can't really use monetary policy to try to contain inflation if the monetary transmission mechanism, that is the banking system, is not functioning properly. So central banks are trying to separate the objectives of controlling inflation with monetary policy and interest rates, and achieving financial stability with other tools at their disposal, primarily balance sheet related tools, like the Federal Reserve has done by increasing loans via the discount window, to increasing loans to banks. A challenge for the environment, again, complicating things, is that policy, central bank policy, whether the Fed or ECB, is highly reactive to data rather than some framework that is easy for investors to understand. And because data can swing around a lot, it means expectations about what the Federal Reserve or the ECB are going to do also swing around a lot. And those swings translate into volatile capital markets. So that is, that's still an underlying issue that makes it more difficult to invest in the very near term. We would argue that interest rates, while they've risen a lot, are not particularly restrictive on the economy. They're not so high as to be strangling economic activity. It's really the speed at which they rose rather than the level that they are that is the problem. And of course, the other element of that is that for most of the past decade, we had very low interest rates, and investors became accustomed to having low interest rates and assumed it was going to last forever. And even the ECB and the Fed suggested it might. Once that started to change, investors and other people were not really ready for it. And as a consequence, that's proved problematic. But I think the household sector was in better shape, because both in the US and in Europe, they had cleaned up their balance sheets and are much better able to handle higher interest rates than a lot of investors were, because capital market appreciation had been quite significant, particularly in the United States in the last decade. The Fed may be approaching a point in which it's going to pause. The market is expecting it to raise interest rates by 25 basis points at its next meeting in May. That the market believes that's the last rate hike to come. The Fed itself is telling us they may be positioned for a pause, but the market's expectations for rate cuts later this year, quite significantly, I think are not in, they're inconsistent with what the Federal Reserve is saying, and they're inconsistent with the way we see the global economy and the US economy and inflation evolving over the next several months. There are going to be a lot of policy divergences across country because the dynamics of the cycle vary quite considerably across countries. But for capital markets, what the Fed does is the number one driver. So a couple of other observations, and this is a bit complicated, but I just want to indicate that when you use traditional ways of determining whether monetary policy is tight or easy, one way of thinking about it is the economy growing, give or take, at about the speed that it can do so without creating inflationary pressures, and is inflation already too high? And the answer is, given how high inflation is in the United States, and the fact that the economy is still growing at a reasonably good pace, first quarter growth is going to be strong, it doesn't really appear as though monetary policy in the United States is actually restrictive. Again, it's the speed at which policy rates have risen more than it is the level that they have attained that is the issue. But one other perspective is, just conceptually, is that, when you look at what the Fed says is the long run interest rate that it believes is normal for the Federal Reserve, which is 2.5%, given that we're at 4 3/4 now, that would make it seem like monetary policy is very tight. But the bond market is priced off of what the Fed thinks long-term interest rates will be, and that seems very low, because the Fed still believes that 2.5% is the normal rate for the Federal Reserve policy rate, and that is far too low in our opinion. And that's really the big issue for the market, is the market subscribes to this view, but we think it's hard to justify that view from the Fed, and we think ultimately that's just going to change. Just for some perspective on monetary policy itself, this is the real interest rate based on inflation expectations in the United States and the Euro area, and they've gone up a lot after a long period of being very, very low. But when you look historically, this is where we were prior to the last, the Great Recession. These don't appear to be all that high in nominal terms, but when you adjust for inflation, interest rates are not particularly high. Central bank policy rates are not particularly high, around 2% in the United States and 0% in the Euro area. Those are not high and stifling interest rates. And that's the reason that we think if the global economy proves resilient, as we expect it will, that the Fed and the ECB are still going to have to be tightening even beyond the May increases that are priced into the markets, right? So the Fed in particular, but the Fed and ECB right now are focused on reestablishing financial stability and restoring confidence in the system by providing liquidity and balance sheet support to US and European banks. But ultimately, assuming that they are successful in that, and they will do whatever it takes in order to achieve that, we're confident of that. But assuming they do it reasonably soon, I think the market is going to have to return its focus to the underlying inflationary problem and recognize that central banks are still likely to keep rates at a higher level rather than be cutting them later this year. All right. So in terms of the investment climate, let me just highlight a couple of simple observations. So the first thing that we look at from an asset allocation standpoint is, what does it look like, the relationship of the performance of stocks relative to the performance of bonds? So it's really like taking an ETF of stocks the value of the ETF divided by the value of an ETF of bonds. And that has been pretty choppy of late, so it's not really very clear how that is evolving. It had been trending slightly higher, which would normally be consistent with an ongoing economic expansion, but there's been uncertainty of late. These are the two asset classes in absolute terms from a total return value. So this is total equity market returns. This is total bond market returns. We're still well off the lows, and this is what we would call a 60-40 portfolio of equities and bonds, and we're still well off where we were at the end of 2021, but we have stabilized certainly compared to where the decline that we had in 2022. So maybe a longer term perspective and how we see things playing out and where we are in the cycle. So that stock to bond relationship, stocks beat bonds. Normally stocks outperform bonds during an economic expansion phase. And these shaded areas show you when we have a recession. The 2020 recession was so short it doesn't really show up. But what this says is stocks outperform bonds during an economic expansion phase and underperform bonds during a recession or ahead of a recession. So when you look at, well, where are we in the cycle? This is the G7 unemployment rate. It tends to be, of course, low during or falling during economic expansions and rising during recessions. When you look at this, the G7 unemployment rate is very low by historical standards. This underscores that it's late in the economic cycle. And if it's late in the economic cycle, it's invariably late in the investment cycle as well. And this is another perspective, return on equity, which let's call it a proxy for the profitability of the corporate sector globally. And when you're in a late cycle environment, you have a high level of corporate profitability, and that indeed is what we have today. So when you look at this unemployment rate, there's not much sustainable downside in our view, and there's inherently upside risks. And when you look at corporate profitability, there's not much sustainable upside for this, and there's meaningful downside for this. And so both of these things tell you it's late in the economic cycle, late in the investment cycle. And although stocks typically outperform bonds if the economic expansion is going to continue, which is our view, you still have to be pretty cautious about your overall investment stance because we are in the late stages of the economic cycle. And as you get to the end, you start to have a period in which stocks significantly underperform bonds, and you want to be favoring bonds over stocks, right? So that's some perspective that I think is important. Just very quickly on bonds, one of the crucial elements is about bonds is the underpinning. There's a real interest rate and an inflation element of it. And when you look at the US, this is kind of a complicated story, but it's a longer term view of inflation expectations in the United States. And it's running at around 2.5%, which we would argue is quite low given the inflation risks that the US is currently facing and a number of forces that we think are going to lead to higher inflation over the longer run in the United States. So the market is being very, very complacent about inflation, effectively assuming that we haven't had inflation in such a long time for such a long time, despite what we've had over the past 18 months, that it's just naturally going to go back to very low levels. Anything is possible, but that is both unlikely, and it's not a very prudent strategy from our vantage point to adopt it today. As a result, it reinforces that we're still cautious about bonds from a longer term standpoint, and really don't think that the price of a 10-year treasury, for example, or the yield, which is around 3.5%, takes into account the amount of inflation uncertainty that prevails for the decade ahead. And we think inflation is likely to be considerably higher over the next 10 years than it's been over the past 20 years. And that means that bonds are still expensive in our view. All right. From a stock market standpoint, very interesting changes that have taken place because of the SVB crisis. When you look at global equities, they were starting to, after the strong decline last year, they were starting to lift, and from a technical standpoint, things looked pretty positive. That was even more the case for non-US equities. Things looked quite positive there. You could see we had a series of higher highs and higher lows, which would normally be consistent with an improving underlying condition, but we've given them all back because of the banking sector crisis of the past couple of weeks. So there's a certain ambiguity about where we are today from an equity market standpoint. Corporate earnings have been pretty solid so far, but there is a risk to the downside, particularly in the United States. I don't think US earnings can hold up. And the US is about 60% of global stock market capitalization. If earnings are biased to the downside in the US, it really is a constraint on global earnings overall. And that's one reason we're neutral today, but with a negative bias on stocks overall. When you think about equity investing, it really is a choice between the US and the rest of the world, because again, the US is 60% of the global market capitalization. The US stock market is still not cheap. It has come down, but it's still not cheap by historical standards. And it trades at about a 50% premium to the rest of the world. That's a very significant premium by historical standards. The more important issue, though, is that US profitability, this is one example of it, return on equity, has been extremely strong, historically strong. And, you know, as the economy has slowed, you've started to see that roll off a little bit. But because of how strong profitability has been, there's a lot of uncertainty about how much downside there is. And a lot of this has to do with technology stocks. Their earnings did extremely well during the pandemic, and they are at risk of falling more sharply than I think many investors currently believe. So when you look at pretty rich valuations for the United States and extremely elevated levels of profitability, we're very cautious on the US, and we prefer non-US markets. This is the PE ratio for non-US stocks, and this is the same profitability measure for non-US stocks as well. And there's a huge gap, and we think the risks are predominantly focused in the US market. All right. So a couple of other observations, just very quickly before I close. You know, European stocks have been under pressure, and European banks have been under pressure, but we still like European stocks. This is the relative performance of European stocks. They've outperformed quite dramatically over the past few months. They're still depressed by historical standards. We still think there's potential upside. And financial stocks, banks, have been under even greater pressure. They had outperformed strongly as well, but we think European bank stocks and European financials more generally are still an attractive area for investment, given our macroeconomic outlook. So, you know, that's been the stress area of late, but that's also the opportunity that has emerged as a result. So, you know, from an equity standpoint, as I said, we're cautious overall with a negative bias. We haven't downgraded stocks to underweight, but there's just not a lot of sustainable upside. There's more upside for European stocks. That's our favorite market. We like emerging market stocks, but that's really because China's got an economic and earnings recovery underway. It's less so for the rest of the emerging market space, but those two are the areas that we like. Now, of course, we have to keep in mind that if the US stock market goes down, it's very difficult for other stock markets to make gains in absolute terms. They can still outperform the US market, but the US is just so instrumental in setting the course for stocks overall that has to be kept in mind. We don't see a huge amount of downside for the US in the short term. We just don't see a lot of upside either. Quickly on the commodity price front, the China economic recovery should be positive for commodity prices, but there's no real theme that we can identify that makes us think it's right to be in commodities right now. They're cyclically sensitive. The global economy is going to be okay, but value is not great, and there's just no compelling story. And I think for gold, which I don't have a chart on, it's important to keep in mind that, you know, if interest rates start rising again, that's going to eat into gold prices. So that's not a place that we like for security in the current environment. And finally, the dollar, and the dollar matters a lot. When you look at the real trade weighted dollar, this is a 50-odd year chart. of the real trade weighted dollar. The dollar has come down, but it's still expensive. When you look at past cycles, when the dollar peaks, it tends to fall quite significantly over a number of years. Now, we'll see, but it doesn't mean anything about the very short term, but we expect the dollar to be lower by the end of this year than it is today against the euro, the pound, the yen, the Chinese renminbi, and so forth. But I think when you look longer term, we also expect the dollar to come down over the course of the next several years. And that will probably be good for emerging markets, and it's good for non-US assets as well. So that reinforces that, we prefer non-US assets, both from a short-term standpoint and from a longer-term standpoint. So let me close there again, just to say, our preference is for cash in the short term because it just provides a good yield and maximum flexibility and lower risk. We still don't like bonds. We recognize that in the late stages of the cycle, at some point we will like bonds, but we think it's premature because we think the market has overreacted in expecting aggressive interest rate cuts from the Federal Reserve, and those will be disappointed, and that means another upleg for bond yields. Equities we're mixed on, but we have a negative bias because we think there's just not a lot of upside, particularly for the US market. And even though there's upside for the European and emerging market stock price indexes, given the importance of the US, it limits the total gains that global equities can achieve, and really risks are skewed to the downside on a 12-month horizon. So, we're neutral for now, but with a downward bias. So let me stop there. I'm happy to take questions, and thank you for listening.
Thank you, Peter. Vamos a iniciar con el periodo de preguntas. Agradecemos que nos las vayan pasando por el chat o igual en el Q&A. Tengo una por acá, Peter. Dice, considerando el dato de empleo, uno de los factores que está revisando la FED para decidir un aumento en tasas de interés, ¿cuál es su opinión sobre este análisis? I will give you it in English so you can also get it. About employment. We know that this is part of what the Fed is reviewing to take any decision on to increase interest rates. What's your opinion about it?
Well, I think, as I showed in the chart, I think the Fed believes that if the financial sector problems that exist today are contained, and the Fed expects them to be contained soon, then the Fed firmly believes that the job market has to cool, that the unemployment rate has to rise. When you look at the Fed's forecast of the economic backdrop, and they just came out last week, the Fed is expecting the unemployment rate to rise moderately over the course of the next year. So that's not that, based on what they say, that's not a deterrent for them raising interest rates. The market believes otherwise. And in point of fact, when the unemployment rate has risen as much as the Fed expects it to over the course of the next year, that has historically coincided with the recession. But the issue is timing. And I think the Fed's view is that you have to raise interest rates first in order to get unemployment higher, in order to bring down inflation, and only then do you start cutting interest rates. The market believes, right now the market is believing that the Fed's going to cut interest rates almost immediately because of whether that's the banking crisis or simply the fact that the economy is poised for recession. And I think that's the market is sequentially has got it wrong. The Fed has to see economic weakness before it can start cutting interest rates. And that weakness will be evident in rising unemployment.
Thank you. Talking about inflation, you said during your presentation that the inflation will continue, but the path to ease, but the path to 2% is going to be difficult. The question is about, is this 2% a real target, or can we have some time, a discussion about that 2% is no longer achievable for the reserve? Do you think that's a way that we can be talking about it in the next months?
Well, so we will be talking about it. Everyone will be talking about it in the next few months. The Fed will try not to talk about it because it fears that if it even allows a discussion about a higher inflation target to develop, then it will start to infect inflation expectations. But ultimately, the Fed will have to determine whether or not it wants to sacrifice, or to what extent it wants to sacrifice economic growth in order to bring inflation down to that 2% target range. My belief is, and our firm's belief is, that the Fed is not going to be dogmatic about when it believes it can get inflation down to 2%, and therefore take risks with the economy by jeopardizing the economic expansion. As long as the Fed can say the 2% target is a medium-term objective that still seems likely for it to achieve it, it will not sacrifice the economy. But it's not going to turn around. Well, we're not going to hear the Fed talking about maybe we should allow inflation to be 3% for a year or two, or we should raise our inflation target. That's not coming anytime soon. The Fed may accept that core inflation is going to be above 3% over the next 18 months in order to sustain economic growth. But it's certainly not going to tell us that. Just one example of that is, you may have heard that when Chair Powell was testifying before Congress, he was asked, what do you say to the 2 million people who will lose their jobs by you raising interest rates? And his answer was, well, there will be economic damage if we allow inflation to stay elevated as well. But it underscores that there's a lot of pressure on the Fed to sustain economic expansion, as long as inflation doesn't seem like it's getting out of control.
Another question is, for a long-term investor, do you think that current levels represent value for the investor to get into the markets?
So, not particularly in the United States. I think maybe there are better opportunities outside the United States, where just a quick chart, although it's just about the Euro area, but this is European stocks relative to global stocks for the last 52.5 years. And although they've risen quite dramatically, they're still very depressed. And there's no guarantee that they will revert towards some sort of historical mean, but it does underscore that European stocks are still depressed by historical standards relative to the rest of the world. And actually, relative to the US, it's even more the case. I think it's important to keep in mind that we've had 40 years of asset price appreciation, particularly in the United States. That was built primarily on the foundation of low inflation and low interest rates. And, not just low, but declining for most of that time. Interest rates, even if they don't rise, they're not going to continue to decline on a sustained basis. And as a result, there's not going to be the kind of asset price appreciation we've had. So it is inevitably the case that returns for balanced portfolios, or for most asset classes, will be lower in the future than they have generally been over the past 40 years, particularly in the United States. That's just the reality of the investment climate we face in the years ahead.
Okay, we're going to take the last question, which says, volatility keeps the investors looking for safe havens. As we have seen that the last days, gold has risen. We have seen as well positive returns on cryptocurrency. Do you think that this is going to be an asset as a new refugee for the investors?
Well, so I think both are related to the banking sector crisis. So for gold, we would argue that gold is inversely related with interest rates, and real interest rates in particular. So real interest rate expectations have been coming down because of the banking sector crisis, and that's helped support gold prices. If the banking sector crisis is contained, as I said, we expect it to be reasonably soon, that's going to, I think, quell some of the demand for the proverbial safe haven of gold, but also it'll imply that real interest rates will rise, and rising real interest rates usually means declining gold prices. So we're not, as I said, there may be a safe haven a bit now, and there are some geopolitical issues at stake as well that are supporting gold, but ultimately we're not buyers of gold at this point. On the crypto side, I think crypto has been a beneficiary of declining interest rates and anxiety about fiat currencies and whatever central banks may have to do to support the banking system. Ultimately, crypto is the main liquidity beneficiary, or one of the main beneficiaries of liquidity. If liquidity continues to get drained out of the system, it's going to hurt crypto, not help it. So, you know, we've never subscribed to the cryptocurrency idea as a core element of an investment portfolio, and we still don't. And certainly at the current price level of, let's call it Bitcoin, we're certainly less positive about it than we were, 20% ago.
Thank you, Peter, very much.
It's, to believe that crypto is a safe haven asset, in our opinion, defies logic. It's very volatile.
Perfect. Thank you. Well, Peter, thank you very much for being here with us. It will be a very pleasure for us to share your analysis. Y a todos los que nos han acompañado el día de hoy y puedan escuchar este webinar, les recordamos que en Mercado de Valores tenemos la prioridad de brindarle a ustedes un servicio de asesoría personalizado, multidisciplinario, enfocado siempre en un análisis constante y seguimiento y cumplimiento de sus objetivos de inversión. Es para nosotros un placer ofrecerles estos servicios discrecionales, premium, de manera que ustedes puedan tener la mejor información a mano. Aprovecho para agradecerles su participación y esperamos que este espacio sea de gran valor. Y los esperamos, por supuesto, en la siguiente actividad exclusiva que prepararemos para ustedes. Tengan todos un buen día. Muchas gracias.
Thanks. Bye-bye.
Bye, thank you. Thank you.